Okay, so I haven't made a video on this channel in quite some time. In fact, I deleted pretty much all of my stock videos, and the reason being, I just wanted to start over with that kind of stuff, and I wasn't really sure where I wanted this channel to go. I still am not completely sure. If you look at my content, um, I still have a lot of product reviews, which I still would love to do in the future here and there, just because I find it fun, and that's what this channel to me was. It was just me talking about different things as I see them as good opportunities to talk about them, and I find them interesting. So hopefully you guys do too. And today I wanted to start maybe a new series. We'll see how this goes. I don't even know when I will throw out this video and I'll release it. But I'm interested in making this into a potential series, and that is selling puts and just kind of documenting that in my journey there on this channel, so you can either learn from my mistakes or, gain some knowledge, hopefully, from me. Not that I'm like the most knowledgeable person about options, because I'm not. So don't get that impression, but it's really just me documenting how this goes. If this goes to shit, it goes to shit. If it doesn't, say la vie. I just thought it would be maybe a fun potential series. I also have another YouTube channel that I just started monetizing. I got to over 1,000 subs, and the 4,000 watch hours took me a while. It was a grind. So maybe as I start making money on there, I can document that too. I have some other video ideas, so open down here. So this is really impromptu. And just to keep my mind on track, I made a Google Sheets presentation here, and I'm just going to talk about options and selling puts and my game plan, some recommendations. However, this is not financial advice. My one recommendation in this has nothing to do with finances, so that's why I say that. The rest of it, I do not recommend you following me because I'm probably wrong. I just want you to maybe, if you're interested, listen and take it as you will, ingest it as you will, go your own way. Okay, so selling puts, let's try to make some money. When I say let's, I mean me. I'm going to see what happens. Like I said, I've been doing this a little bit here and there. I've been dabbling in it, but in the past month, I think I've really dedicated some time into seeing what stocks I would like to sell puts on, thinking about this almost every day, looking at different companies every day, seeing how they're performing that particular day, if it would be a good option to sell a put on that stock. And I guess I've just been taking it more seriously. So yeah, let's try to make some money. We'll see what happens. Like I said, this isn't financial advice. If you were smart, you wouldn't follow me because I have a knack for starting something and it's starting off well, but then in the end it just goes miserably. So that's why I'm documenting it. Maybe it will, maybe it won't. We'll find out. But if I were to give some bullet points on what you should do, like I said, this is the only time I'm going to recommend something because it isn't financial advice. But if you're also looking at selling puts or selling calls, because maybe your put has been exercised, now you have that 100 underlying stock, that 100 shares of it, and now you're like, okay, well, I don't want to own this forever. I would also like to sell some calls, maybe way out of the money, maybe not so out of the money, maybe pretty close. I would recommend this for either of those situations. Keep track of your trades. I use a Google spreadsheet, Google Sheets. It's completely free. And I'll show that off at some point, but I just have columns like, here's the date I made the trade. Here's what it was. It was a put that I sold. Here's the premium I got. Here's the strike price. Here's the stock, the underlying stock. And here's the expiration. And then at the very end, I'll say, was it exercised? And how much total did I make from that option premium? Did I buy it back at a loss? Did I buy it back at 95% up? Just keep track of all that, because you may fall into some ignorance in where I could see myself doing that. You think you're doing great, and then on paper, you're actually just maybe breaking even or barely making any at all, where you'd be better off just not wasting your time. Or maybe you're losing money, but for some reason you think you're just doing fantastic. I could see myself doing that. I don't want you to do that if you are interested in selling puts or selling calls or whatever. Just keep track of it. Something you can see over time how you've done, have a track record. Maybe it can even hype you up to keep you doing this in the future. If you're not someone if you're like me who does something for a little while and then they chase the next shiny object, maybe this will keep you on the path if this is seriously something you would like to do for a while. So that's why I say it. Just keep track of your trades. You don't have to use this Google spreadsheet. Just use a piece of paper. However, you have to be committed to tracking what you're doing. Because if not, there's no point. If you only track the wins and not the losses, then it's just going to be misleading, and you're just going to probably end up losing a lot of money. Next, find some stocks you like. So the thing about selling puts is they might get exercised. If you don't even know what a put is, this isn't really about that. This is more of my journey, I guess. But I guess I can give a brief explanation. Pretty much what it is you now have this obligation, this contractual obligation, that if a stock goes to a certain price or below by expiration, by some kind of date, you then have to buy 100 shares of that stock. And for accepting this contractual obligation, that person is going to pay you some money up front that you get to keep whether or not that option is exercised, aka you have to buy that stock. So what happens is, if I sell a put for Ford at $10 and it expires in 2 weeks, if Ford is $12 in 2 weeks, remember my contract was 10, my strike price, I don't have to buy that stock. It expires worthless. That option contract expires worthless. I get to keep the premium that the person paid me at the beginning though. So maybe I sold that put for $10 and I got $20 worth of premium. I get to keep that $20. The option contract expires worthless, and we both go on our merry way. And the terminology is a little bit confusing. You hear sell a put, you might be thinking, by how I explain that, shouldn't it be called buying a put? Buying a put means that you pay someone some premium, and if that stock goes below the strike price, they have to buy it at that strike price. So if Ford ends up going to $7 a share in 2 weeks and my strike price was 10, I theoretically am down $300 because now I have to pay $1,000 because $10 is the strike price times 100, and the stock is currently worth $7 a piece. So there's a $3 difference times 100 shares that I own. That's $300 difference. So I'm now $300 in the red. And that is one of the downsides with selling puts, I would say. So that's a brief explanation on what puts are. Maybe that wasn't the best explanation. Like I said, this wasn't really intended for that. So if you want to know exactly what a put is, I think In the Money, it's a YouTube channel. This guy talks about options a lot. He's really good at explaining it, way smarter than me. So go check out his video and it should make sense. But I like to keep a list of stocks. For me, it's a mental list, but you can also write them down, maybe make a watch list on your brokerage of choice. And it could be all the different stocks that you'll keep an eye on day in, day out, and see if it's the time to sell the put or not. And keep in mind, when sentiment is down on a stock, that's usually when you make the most premium. So if Ford was on a downtrend, maybe it was down 3% in a day, and it was getting closer and closer to that $10 strike price. If I sell it as it's down, I'm going to make more premium than when it's soaring up to the moon. Just because someone's not going to pay me a lot of money if the stock seems to be going up and they only benefit when it goes down, right? Doesn't make sense for them to shell out a lot of money. So if you really like the stock and you don't mind owning it at that strike price, then you're cool with it being exercised and you get to keep that stock because you believe in that company regardless of the short-term sentiment. And that's one of the requisites for your list. It needs to be a stock that you're comfortable owning and potentially holding for a while. Because if it does get that exercise like Ford, I'm okay with holding Ford at $10 a share, even if it goes all the way down to 7, because I'm a believer in that company and I see it going back up past 10 in the future. So yeah, just have a list of some stocks you can keep an eye on if you are looking to sell a put. If one goes down and there's not really a good reason for it being down, maybe just the market's down in general, maybe there was some FUD, who knows, you now have your list. You can keep an eye on them and, be ready when it's ready. Next, what I do. So like I said, don't follow my example. I'm just documenting this to, I don't know, maybe share with you guys so you learn. Maybe to look back and say you were an idiot. We'll see. I use Robinhood to trade options. You guys might already hate that. I just do it because it's super simple and it's pretty user-friendly with options. I also use margin as my collateral. So another thing, when you're selling puts, you have to put up the amount of money as collateral. So if it does get exercised, you can indeed buy that stock. So back to our example, if I sold a put for Ford at $10 strike, then the brokerage would take $1,000 of mine and just lock it up until that option is either exercised or expires. So now I have $1,000. I can't do anything with it. It's just going to sit there. And in that case, I use Robinhood's money, because what's cool about Robinhood, at least for right now, as of recording this, they don't make you pay interest on that until it is exercised and you actually use that money to buy the stock. So if my option doesn't expire for 30 days, I don't have to pay interest on that money that's locked up in that option. Just kind of sits there. So there is a lot of risk with margin though, so I don't recommend doing this. I do it just because I have money on the side that if I have to pay off the margin, I can go ahead and do so. And I guess that's the thing that gives me relief when doing this. Now, if you don't have the money to pay off the margin, I definitely don't recommend doing this, just because you may be margin called in the future and you would hate to go through that. Okay, so that's it. That's my little slideshow. I guess we can talk about some examples as well. Some stocks that I like to sell puts on, and maybe you can get more of an understanding. So let's go on Robinhood. And one of the stocks I really like to sell puts on, you can see right here, is Riot Blockchain, a Bitcoin mining company. I own a little bit of Riot myself. I only own 5.2 shares, but I've been selling puts on this stock a lot recently. And you can see I have one put right here that I sold. It expires 10/29. It's now 10/24, so this coming Friday it expires. And it's a $28 put. So if it goes below $28 by the time of expiration, I will end up having to buy 100 shares at $28. Which, like I said, I'm cool with, because I only do this with stocks that I could see myself holding. I like Riot Blockchain, and so I'm fine with selling a put on Riot. Now, if we look at this particular option, I have lost money on it so far. Quote unquote, lost money on it. The option is now worth $123. So if I were to sell another put at the same exact strike price, at the same exact expiration date, I would make $123 in premium. Back when I sold the put, I only made $101 in premium. So that's what this loss really means. You didn't actually lose money. It's just like opportunity cost. You lost the opportunity to make $123 when you only made $101. And the reason it went up between when I bought it and now is because the stock took a dip last week and the value of that sell went up in premium price. But if the stock ends up going up, and let's say tomorrow, Monday, it starts shooting up and it goes all the way up to $31, I would expect the value of this put to decrease because it's getting farther and farther away from the strike price of $28. And usually when I like to buy back the put, meaning that I'm just going to close this contract by paying a little bit of money and buying back my obligation, so I no longer have that obligation to buy that stock, I usually do it around 90% or so. Sometimes I hold it all the way till expiration just to make a few extra dollars, but some other times I do buy back the put. So Riot Blockchain is one that I like to sell puts on. I do have a few more, which I will hopefully talk about in future videos. I just thought this would be a good first video maybe to talk about it. And if you're interested after watching this one, you can stay tuned for the future. And yeah, that's pretty much it. Hopefully you guys are excited to go about this. I hope to see you guys in the future. And yeah, take care.